Hi and welcome to our course on mastering market timings, when to buy or sell stocks. So knowing when to buy or sell stocks is the difference between building wealth and watching opportunities slip away. But the good news is you don't need a crystal ball, just a systematic approach using proven indicators. So today we'll walk through technical signals, market conditions, emotional management and sentiment gauges that tell you when to act. Now we're going to look at two technical indicators that are worth considering. So the first is the Golden Cross and RSI. So the Golden Cross is one of the most powerful buy signals in technical analysis. It occurs when the 50-day moving average crosses above the 200-day moving average. So if you can picture two lines intersecting on a chart with the faster line breaking upwards. So this signals upward momentum. And the Apple Golden Cross in May 2023 preceded a 40% rally over the next 6 months. And if you were to pair this with the RSI, which is the relative strength index, you get a powerful indicator. So the RSI below 30 means that the stock has been oversold, so it's a potential buy. So too many people have sold the stock. And above 70 means that it's been overbought, so too many people have bought the stock, so that would be a time to consider selling. So the sweet spot for an RSI would be between 40 and 60, with the Golden Cross forming at the same time. And that would be your green light to enter that trade. And when both align, you've got confirmation from price momentum and from relative strength. Our second indicator on the technical side would be support and resistance levels. So support levels are like a safety net. The price bounces off them repeatedly. So when you see a stock test, say, €45 3 or 4 times and bounce each time, that's a strong support. And a rising support line, say from 45 to 48 to 51, that's a staircase of profits there. And that is the strong buy signal for you. A resistance, that works the opposite direction. So falling resistance from, say, 60 to 57 to 54, that means weakness is building in the stock and it's maybe time to start considering selling. Our next indicator will be general market conditions. So if we look first at bubbles. So bubbles are easy to spot in hindsight, but they're trickier in real time. So the key for spotting a bubble will be to look for extreme valuations that defy logic. So when the Shiller PE ratio, which is price to earnings adjusted for inflation, if that exceeds 30, then historically markets correct. And in 2020, it hit 44 before the dot-com crash. And in 2021, it reached 38 just before the 2022 sell-off. And our second other indicator would be index patterns, so higher highs and falling rallies. So a healthy bull market, that would make higher highs on increasing volume. So if, for example, the S&P breaks above 5,000 and then 5,200 and then 5,400, each time with stronger volume, well then that's buying momentum. So it's the extra volume keeps pushing up the value. So you want your stock, you want to own stock in that environment. But if you were to watch for warning signs, well, when the index pushes to new highs on declining volumes, well then that's the market is pretty exhausted. And it's time for you to consider the weakening volume be a signal to get out of the market at that point. Now, to find all these stats and figures and market information, a good website would be Yahoo Finance, or finviz.com is also another very good website to give you PE levels, volume levels, and index levels. Now we're going to look at exercising discipline over your transactions and stock purchases and sales. So the first one we're going to look at is about writing a trade ticket. So before you buy a single share, you should get a piece of paper and you should write down, I am buying X company for Y reason, and I will sell it if it drops to this price, or if the fundamental reasons change, and you could list out those reasons. And that basically is your contract with yourself. So for example, you might say buying Microsoft at 380, selling 25% if the price gets to 450, selling another 25% if the price gets to 500, set a stop loss at 340. And if, for example, its cloud computing section drops by 20% revenue, well then I'm going to cut out of that position. Something along those lines. So when your emotions are screaming to hold on or to sell or whatever it might be, that piece of paper becomes your rational voice, keeping you grounded when the euphoria or the panic starts to take over. Next, you need to use limit orders to set your price when you're buying. So market orders are for people who want to accept whatever price the market gives them, but limit orders are for disciplined investors who know their numbers. So if you've decided that Bank of Ireland is worth 9.50, set a limit buy price at 9.45 and don't chase it to 9.80 because you're excited. So the same goes for selling. If you've determined your stock is worth €55, then set a sell limit at 54.50 and don't panic if at 48 euros the market dips. So think of it like it's buying a house. You wouldn't just say, I'll pay whatever the seller wants for the house. You'd set a maximum price and you'd walk away from the house if that price was exceeded. Limit orders give you control in a chaotic market and they remove emotion from execution. So you've already decided your price when your head was clear, so not when fear or greed is screaming at you. Next we have dollar cost averaging, which is the same as buying in tranches. So you never want to go all in one purchase. So you want to split your position into thirds or quarters. So for example, if you want to invest €3,000 in AIB, you could buy €1,000 worth today, €1,000 worth next month, and €1,000 worth the month after. This is dollar cost averaging, whereas buying at different prices reduces your risk of terrible timing. So if the stock was to drop after, then that's great. You can buy more shares cheaper with your second purchase. And if it rises, then you've already got exposure with your first tranche at the lower price. So you win either way. So this strategy smooths out volatility and keeps you emotionally balanced. And finally, we've got the strategy of taking profits as they grow. So when your stock gains, say 20% or more, you should sell a portion of your position, typically 25% to 50% of your position, and that will lock in your profits. And then you let the remainder just ride on. So basically it comes from the principle of smart people taking chips off the table when they're in the money. So your stock portfolio deserves that same sort of respect. So profit taking, it's not been pessimistic about the future, it's been pretty much professional about your profit. So now we move on to the very interesting area of sentiment indicators. And the first one up is the VIX index, or the fear gauge, or sometimes called the fear index. So VIX measures the expected volatility in the market, and it's essentially the level of fear that is in the market. So a level below 12 means that everyone's complacent and probably a good time to raise cash or sell your positions. Between 12 and 20, that's normal, healthy market conditions, so you can hold your position comfortably. 20 to 30 means elevated fear, caution is creeping into the market, so you need to be alert to opportunities. And above 30, well then that's panic mode, and historically the absolute best time to buy quality stocks. And the VIX is a free index that you can check online at most of the financial sites. Would have the VIX index. So you should bookmark it on your computer and you should check it every week just to get a mood in the market. The second one up is the CNN Fear and Greed Index. So this is a brilliant tool that combines 7 indicators into one simple reading from 0 to 100. So 0 to 25 is extreme fear, a contrarian buying opportunity. So the crowd is panicking, which means that assets are getting cheap. 25 to 45 is regular fear. 45 to 55 is neutral normal market. And here's where it gets interesting. 55 to 75, we're in the greed territory and market is getting frothy. So maybe it's time to sort of pull back some of your positions and maybe do a little bit of selling and take some profits off the table. 75 to 100 is extreme greed. And this is when you wish you didn't invest in stocks at that point. So it's time to sell your positions and start taking your profit. And you can always get back in when the gauge falls back out of the extreme greed territory. And this is on the CNN website. It's a great indicator, and again you should bookmark that and use that weekly as well as one of your sentiment indicators. Third up is the American Association of Individual Investors survey. So this is a weekly survey that's done to determine whether the investors are bullish, bearish, or neutral. So it's pretty clear to understand what's going on. Is the market a bull market or a bear market? And that gives a general mood of your average personal individual investor. So that's another one to bookmark, check out. You can go to their website, the AAII website. The final sentiment one we're going to look at is put and call ratios. So these are for option trading. So while we're not talking about option trading here, we just want to see what other people who do options, what they're seeing and what's going on in that market. So the options that measures puts. A put option is a bet on falling prices and a call option is a bet on rising prices. So where the ratio is above 0.7, that means there's more puts are being bought than calls. So its bearish sentiment is building. And that often signals a bottom or near bottom of the market. Above 1 is even better. It's extreme pessimism or contrarian buying signal. And below 0.6 means excessive optimism. Everyone is betting on higher prices. So it's a warning signal to take profits at that point. So option traders often move before the stock investors. So this is a sort of early warning system. And again, it's good to bookmark that on your computer and check it out every week. So a combination of all four of these should give you an overall sentiment picture of the market and give you a mood of what's going on and what direction you can expect the market to go in. So how do you combine all these indicators into a decision-making process? Well, the first one we look at is a contrarian checklist of times when to buy. So you should be buying when the fear is rampant in the market and everybody else is selling. Specifically, look for the VIX above 30, the fear and greed index below 25, put and call ratio above 1.15, and the AAII bulls below 25. When you see 3 or 4 of these together, well then, that's a good signal of time to buy. Add to this media headlines and predicting an apocalypse where it says something like market faces the worst crisis since the Great Depression or something along those lines. Well then, it's time to get out into the market and start buying quality stocks at that point. Now, contrarian checklist of time to sell. Selling is much harder than buying because we get emotionally attached to winners. But when you see the VIX below 12 for weeks and the fear and greed above 25, put and call ratio below 0.6 and the AAII bulls above 50, well then it's time to trim your holding and take some profit off the table. For a contrarian time to hold, most of the time you should be doing nothing and it should be pretty boring. But when indicators are in neutral territory, VIX between 12 and 20, the fear and greed between 45 and 55, sentiment surveys are all balanced, well, you just hold your quality positions at that point. And this is when healthy breadth in the market supports price moves, advances decline lines confirm the index is strong, and there's no extreme fear or greed in the market. So things are boring, but it's time to just be patient and make steady gains over that period of time. Another indicator to consider would be the Buffett indicator from Warren Buffett. So this is Warren Buffett's favorite metric, and it compares the total stock market capitalization to GDP. So it's checking to see are stocks reasonably priced relative to the economic size. So below 75% means the market is undervalued and it's an opportunity to buy. 75 to 95% means it's fair value, which would be normal buying. 90 to 115% is it's slightly overvalued. Again, pretty normal buying, but just be selective. And above 115 would be a signal that it's overvalued. So this doesn't mean that it's going to crash tomorrow or anything. It just means it's overvalued. But so future returns will likely be lower, and there may be corrections or sharp corrections to come. So you can check out this indicator at currentmarketvaluations.com, and it updates regularly. And you should use this in context with all the other indicators as a sort of big picture indicator to tell you the overall larger background music, not an individual indicator in itself, but more to confirm other indicators. So here are some golden rules you should apply to your investing. First one up is, if you like a stock at 50 euros and the fundamentals haven't changed, well then you should really love that same stock at 40 euros. So the lower price is a gift, not a problem. And many investors do the opposite. They get excited at 50 euros and they get scared at 40 euros. So the second one up is time in the markets beats timing the markets. So you can't predict those days when the market takes off and it all happens. So it's important that you stay invested. So you should use these indicators to adjust your position size and not to cash in your position. The third one, which is my favorite, the stock market is a system that transfers wealth from the impatient to the patient. So a day trader checking prices every hour, well, essentially he's just donating to the investor who buys quality and holds for years. So it's important that you're the patient investor. So now you have a complete system. Technical indicators to show you the trend, market conditions to reveal danger or opportunities, emotional management to keep you disciplined, and sentiment gauges to tell you when the crowd is wrong. So this week, your homework is to bookmark the VIX index, the Fear and Greed index, the AAII survey, and the put and call ratio. Bookmark all of those onto your computer and check them weekly, maybe on a Sunday evening, to get a gauge of how the market is going to be for the week ahead. And then if you're considering buying in that week, write out your trade tickets before your purchase, set the limit orders, not market orders, and remember that these tools work best at extremes, not when everything is calm. So the next time the VIX hits 30 and everyone is panicking, you'll be calm, you'll be armed with the knowledge and ready to buy. And when the VIX drops to 10 and your friends are buying anything that moves, you'll be taking profits. So you need that discipline and that contrarian mindset to build real wealth with your investments.